Central banks just accelerated gold buying past 1,000 tons annually. And at the same time, gold and silver experienced the most violent volatility in modern history. Gold surged toward $5,600 per ounce, then crashed 20% in 3 days. Silver broke $100 for the first time ever, then collapsed over 40% just as fast. This wasn't normal safe haven behavior, this was parabolic. And after that brutal correction, investors are asking one question: is the precious metals rally over? Or was that just a reset before new highs? Today we're breaking down what caused the explosion, why gold looks stronger than silver long-term, and what signals to watch next. What ignited the rally? Gold's biggest buyer isn't retail investors, it's central banks. In 2026 alone, central banks bought 863 tons of gold, far above the 2010-2021 average, and they kept buying even at record prices. Why? Because gold is neutral capital. It's not someone else's liability. It can't be frozen, it can't be weaponized. With geopolitical tensions rising and frozen reserves becoming political tools, countries want reserves without political risk. That's why emerging markets, especially China and others, are diversifying aggressively into gold. And surveys from the World Gold Council show most central banks expect gold allocations to increase further. The debasement trade. The second driver, currency debasement. When governments face massive debt burdens, they tend to manage it through higher inflation, lower real interest rates, financial repression. That environment historically benefits hard assets. Institutional investors weren't speculating, they were reallocating. Gold ETFs saw one of their strongest years ever. Physical buying surged globally. In China, gold investment demand even surpassed jewelry demand for the first time. This wasn't a fringe trade, it went mainstream. Why silver went parabolic? Silver has two identities: monetary metal, industrial metal. And in 2026, both stories aligned. The Silver Institute reported a fifth consecutive supply deficit, around 149 million ounces. Industrial demand from solar, EVs, and AI infrastructure kept rising, so silver had the perfect narrative: monetary protection plus industrial growth. But here's where things changed. What caused the crash? Fundamentals don't cause vertical melt-ups. Leverage does. The final sprint higher wasn't long-term investors buying coins. It was futures traders using leverage. When gold dropped 20% and silver 40% in days, that wasn't fundamentals changing. That was liquidation. Exchanges like the CME raised margin requirements multiple times. When margin rises, traders need more cash. If they don't have it, they sell. Selling increases volatility. Volatility triggers more margin calls. More margin calls force more selling. It becomes mechanical. Silver got hit harder because it's thinner and more volatile, and once the forced selling stops, you get sharp rebounds. Not because fundamentals improved overnight, but because liquidity thinned out. The Fed shock. The immediate trigger? Kevin Walsh's nomination to replace Jerome Powell as Fed Chair. Walsh is seen as more hawkish. Markets had priced in heavy debasement and aggressive rate cuts. The idea of a more disciplined Fed punctured that trade. But here's the nuance. Political pressure favors lower rates. Debt levels favor lower real yields. The long-term debasement argument didn't disappear. It just became overcrowded. And crowded trades unwind violently. Gold versus silver, the big difference. Gold and silver get grouped together, but they're not the same trade. Gold's advantage: gold has a structural buyer, central banks. They don't get margin calls. They don't panic sell. They rebalance reserves. Gold's share of global reserves hit 23% in 2026, more than double 2015 levels. That steady institutional bid gives gold stronger long-term floors. And importantly, gold has already exceeded its 1980 inflation-adjusted high. Silver's reality. Silver doesn't have that official buyer base. It relies on industrial demand, speculative flows. Both can reverse quickly. Silver's history shows explosive spikes, followed by long sideways periods. Even though it just made a nominal record high, inflation adjusted, it's still below its 1980 peak, near $200 in today's dollars. Silver is high beta, gold is monetary anchor. What to watch next? If you want to know whether this rally resumes, watch three things. 1. Central bank buying. If countries like China continue adding to reserves, that's structural demand. 2. Real interest rates. Precious metals respond to real yields, not nominal rates. If real yields fall, metals benefit. If real yields rise, metals struggle. 3. The US dollar. The dollar acts like a lie detector. If it weakens despite rate differentials, that signals growing policy uncertainty, which fuels gold. If it strengthens sustainably, metals face pressure. So, is the rally over? The long-term structural thesis, rising debt, political pressure for lower real rates, reserve diversification, geopolitical fragmentation remains intact. But parabolic moves rarely continue immediately after liquidation events. Markets need time to rebuild positioning. Gold likely remains the more stable long-term play. Silver, still explosive, but far more fragile. Final question, was that blow-off top the end, or just the first act of a larger monetary transition? Let me know what you think in the comments. And if you want deeper analysis on where monetary policy is headed next, check out the video linked on screen. Like, subscribe, and I'll see you in the next one.